In this next section, we're concentrating on the turtle trading system, which is based around what's called Donchian breakouts. Donchian breakouts are extremely popular methodology within both the professional and the retail market. And just to give you the definition, it's quite simple. All it is to say that price is making either a 20 bar high or low, or in some cases, for some traders, it's making a 55-day high or low. Not surprisingly, what we're trying to do here is to identify sideways markets and then to a certain extent identify the breakout from that sideways. On this chart here, which is just dollar Canada on a daily chart, I've just marked two red lines, and what they are is just a 20 bar channel. And so when, in this particular case, we can see that the channel is falling, it means that price is making a fresh 20 bar low. And in this case here, when it's rising upwards, we can see it's making a fresh 20 bar high. Now, looking at this chart, we can see that if we got involved in this area here, and certainly if we pyramided, i.e. add to our position as the trend develops, then there would be some considerable profits to be made. However, if we then look at some of the data subsequent to that, we can see that there's various instances where we just make new highs, we just make 20 bar lows here, and then we just make 20 bar highs again before the market subsequently reverses. This highlights one of the perennial problems with simplistic breakout systems such as Donchian, in that what you make in decent trends, there is a great danger that you're going to give all that money back, and possibly even more, when the price goes into sideways. Generally, markets go sideways between 60 and 70% of the time, and so unless we have pyramiding techniques or very, very good money management techniques, what we make in trends we are going to lose in those sideways periods. Here we have a website that is called The Original Turtles, and you can see the link up at the top here. You can also go to Google, type in turtles, and there's a large variety of websites associated with this particular methodology. The reason I chose this one is that it's not really trying to market anything, it's not trying to sell anything, it's just trying to say what the original rules of the turtles were, because sometimes that has been distorted over history. Now, what the turtles did originally was to take that Donchian breakout theory of 20 and 55-day highs, and then they had their own methodology for pyramiding into that particular trade. Here I've recreated a basic turtle system, and the first entry is just to say that price makes a 20 bar high by just one tick, and if I click on the parameters, we can see that the name Chan has a reference of 20 bars. The important thing there is that they're not waiting for the close of the bar. They're getting involved as soon as it goes above that level by one tick, which means that you're always entering a position on stop. Subsequent to that, they had various pyramiding techniques which were all linked to the average true range. So if I go to the second long position, it's then taking the original entry price of the first trade and saying that if we go 0.5 times above the average true range over an exponential 20 period, then I'm going to pyramid in. Then long 3 is going to do it based on 1 times, and long 4 is going to do it 1.5 times the average true range. They also use the average true range to define the stop loss on the initial position, and here we can see as an exit code the stop loss was the entry price minus 2 times the average true range. And in this particular system that was built for a customer, the subsequent pyramids had slightly different average true range. So this one had 2.5 times because it was getting in half times above the original entry. Then this one would have 3 times, and long 4 would have 3.5 times.